You don't have to guess what's going to be appealing in this market. Go look at who's driving the most amount of revenue, and you're going to see what do they visually look like, how are they designed, and then you can start reading their reviews because that's direct customer feedback.
Welcome to the Fully Funded Show. Whether you're a capital raiser, deal sponsor, fund manager, or LP investor, we've got the insights you need for investing success. Join Sam Silverman each week for expert interviews, insider tips, and strategies to fully fund your ventures. Let's go!
All right, we're back with the Fully Funded Show, this time with Taylor Jones. Taylor is a close friend of mine. I worked there for the last few years as well. He leads acquisitions and is probably one of the best people in the STR space right now in terms of helping underwrite, identify areas of opportunity, and really just find quality properties for short-term rentals. But Taylor, I'll turn it over to you to give yourself more of a formal introduction.
That was pretty good, man. You stroked the ego pretty nicely.
There you go.
Yeah, no, lead acquisitions have helped acquire over 160 short-term rentals the past 2 years. And, really just kind of got into this from a numbers perspective. As a washed up baseball guy, I was kind of used to numbers. I always say your batting average is your batting average. Your RBIs are your RBIs. There's no faking it. There's no emotion. And kind of short-term rental investing is really like that. Is your numbers are your numbers. And if you let emotion cloud your judgment, that's where you can get in trouble, where you start thinking, oh, I can make this property better than it actually is or better than the comps. And if you stay disciplined to your comp set, to your underwriting, you don't give in, you don't underwrite OpEx too low or make critical mistakes, it gives you a lot of chance of success. And after repetition and underwriting hundreds of deals a week, it's truly become kind of like a big superpower here to be able to find, acquire, successfully underwrite short-term rentals at scale across the US.
So walk us through how you get into this space in the first place. We can get into the whole history and actually what you do on a daily basis now, but why short-term rentals? Why did you go all in on it? I know you're actually all in on short-term rentals before TechFester as well. So kind of help us understand how you got there and why.
Yeah, lifelong sales guy, just chased different commissions, various sales jobs the past 7-8 years. Had a client-facing sales job, so we would sign contracts face-to-face. COVID hit, and that obviously put that on pause in March of 2020. I wasn't fired, but I couldn't go sign new business. So I couldn't make any money, but I wasn't laid off. And so we were just kind of waiting it out until they allowed us to go back in person and sign new contracts and bring in new commission. So March, April, May of 2020, I had all the time in the world, which was kind of a blessing in disguise. Always had an itch for real estate. And I wasn't really sure what I wanted to do. I looked at everything from wholesaling, flipping. I'll even tell you in March of 2020, when things were really dicey, we weren't sure how bad it was going to be. I heard somebody on a podcast who does Section 8 rentals, and they were like, man, I sleep well at night. The government pays on the first. I actually went and got Section 8 landlord certified in Orlando, where I was living at the time, just considering that as a path. Never did anything with it. My certification might have expired at this point. I don't think I renewed. But looked at everything, do I want to flip, broker, multifamily, anything under the sun? And I've been a consumer of Airbnbs since 2015. Looking at my account, me and my wife have stayed in 26 different Airbnbs across the world. So I always knew the product from a consumer side, but never looked at the numbers from the host side, and started studying, looking, and I was like, oh my gosh, the returns here are great. And this was, again, 2020. So you're like, oh my gosh, this is amazing. Dove in, consumed YouTube content, read Bigger Pockets, of course, like everybody does when you're getting into real estate. I read some short-term rental books. And I think the great decision I made that a lot of people get stuck on is analysis paralysis. I kind of figured I knew enough to get by. Like maybe I don't crush it on the first one, but I'm not going to drown. And end up writing an offer on a cabin 8 hours away, sight unseen in a different state. Got it under contract, flew up to Atlanta, drove to the Blue Ridge Mountains for the inspection. It's like, okay, here we go. The inspector gave me that ounce of assurance when I met him. And he's like, man, some small stuff, but like, it's a pretty good property. And I was like, okay, sounds good. Flew back home to Orlando. We closed. I went back up there, spent a week and just did a ton of sweat equity. We swapped out furniture, updated the game room, the fire pit, the hot tub, made it what it should be. And I remember we listed on a Tuesday night. And I woke up Wednesday morning, had 4 bookings for over $8,000. And I was addicted. I was like, holy crap, like here we go. And my high level plan was cool. I'll keep the high paying sales job. And that eventually came back, of course. And then I was just buy one a year for the next decade. I'll have 10 of these and, they're spitting off 20, 30, 40 grand in free cash flow. Like I'll be set. But once that first one came in, I was addicted. 4 months later, I bought the second one. So I did not make it 12 months. Bought that second one, was off to the races, and I was actually broke. I was out of cash. I just burned through all my capital. And that's where I started looking at, how am I going to get the next deal? And naturally, when you have success, I got friends, family talking to me. My uncle works for Oracle. He's like, yo, I'm in for 100 grand on the next deal. My other uncle does, engineering work. He's like, hey, I'm in for 50, 100 grand. And I didn't know what a syndication was. I didn't know what joint ventures were. I was not as sophisticated as I am today, but I was kind of naturally building my own little mini syndication fund, getting commitments from friends and family, and I didn't even know about it. Come in and like, okay, let's start putting the pieces together. How do I do this legally? Start talking to attorneys. And meanwhile, a couple months prior to that, I started just posting me and my wife's journey on Twitter, of all places, and had no idea what was going to come of it. And I just start talking about, this is what we're doing. I'm posting every day about short-term rentals. Here's our numbers. So I was sharing numbers online back before it was cool. Now a lot more people are open and transparent, but I started sharing and started taking off, had like 1,000 followers, and this random person with like 62 followers, no posts, slides into my DMs. And it's like, hey, we're building a short-term rental fund and, would love to talk to you and have you on the team. And I was like, who the heck is this guy? And come to find out it's, Sif, who's the, co-founder of TechFester. And he tells me about, hey, we just launched this fund, it's like barely 30 days old. And, would love to have you on the team, and we need a numbers person on the acquisition side. So, the team was small. Everybody's wearing multiple hats. You got to start delegating. And I kind of told him, well, actually, I'm going to start my own, like thanks, but no thanks. And it took 3 to 4 weeks of convincing, and told me why doing my own would be a terrible idea and I should join his, and it would be a better, and we could build it bigger. I eventually got sucked in, and, if anybody knows Sif, he's a very good convincing sales guy, and he kind of convinced me that I should do that. I left the sales job, went all in, and was like, okay, let's go join this real estate private equity startup. And that was kind of how I got recruited and started to join TechFester and lead the acquisitions journey.
Yeah, I think it's something that you did that actually helps quite a bit, and most people don't do, is in the world of real estate, it's very easy to get sucked in and spend a ton of time doing nothing, right? And I think the biggest part of your education, I kind of look at this like the college teacher who goes out and keeps teaching versus actually going to do something, right? Likely not your best teacher, right? I think the people who go out and take a level of risk, right? Like you're more likely to go figure things out if it doesn't go well, if it's your own money in there and you're doing something. If you're just kind of reading a book, you're like, this is how I'd handle it, this is how I do that. So good on you for actually going out and starting it. And then, coming in TechFester too, like, what was it like when you first started? What were you focusing on? How are you going about finding properties to go acquire? Just because the 160s in the last 2.5-ish years, give or take?
Yeah. And starting out, we didn't have as much data as we do today. It was really like truly grinding on a one-on-one basis. And early on, we weren't as disciplined from taking advantage of things you don't realize at scale. It's kind of laughable to the goals that were set out that first year. I think if I remember, it's like, man, it'd be great if we could like deploy 15 million in the next like 12 months, and you just like shatter that without blinking. But really the goal was like, is this even going to work? We were still proof of concept, and, tons of people bet on us and kind of, entrust us with their money when it was still just an idea, dream, and hey, here's what we want to do. And, not even double-digit properties yet. And then it just kind of like, it's just a one brick in front of, one foot in front of the other. It's a brick by brick business. It's not venture capital. It's not SaaS. It truly is one at a time. And as you start stacking those wins, you get a little bit more traction and a little bit more traction. And so what would happen is we kind of started with places we know and, great vacation markets. And as we dove further into the data, we kept pushing forward. And I think one thing we learned over time was we would find deals scattered across the US, gave you good diversification, but then you're stuck with 2 over here, 2 over here, 2 over here. As we've scaled, we've learned the importance of density, the levers that you can pull on a variety of factors, both from an acquisition standpoint, a OpEx standpoint, internal support standpoint. But really it was just continuing to learn as you go. And, to the comments you made about really understanding, diving it in, I think the analogy I always tell people, you don't have to be Michael Phelps when you jump in the pool. You just got to know enough not to drown. If you can just tread water in whatever you're doing, whether it's, again, hey, I want to go into self-storage, multifamily, I want to flip, I want to go into short-term rentals, that everybody thinks you have to be Michael Phelps from I know everything, I've studied, I've read every book. When in reality, I look at it as when you jump in, you have to just know enough to get by, because I learned more in that first 90 days of operating that first cabin than I did in the 3+ months of studying that it would have taken. And that gave me the confidence to jump right in 4 months later and buy the second one. As I was like, okay, it's not scary. It's not overwhelming. I know enough. I've understood it. You encounter the same situations. And to me, I always looked at everything as, is this a one-off example, or could this be automated and delegated? So for example, you have a fireplace in the mountains, and the Blue Ridge Mountains are the closest mountain range for us Floridians to drive to. Well, nobody in Florida has a freaking fireplace. That doesn't exist. So of course you get all these idiots who are like, hey, how do you turn the igniter on and the propane? After one or twice hearing that, you're like, okay, I'm going to set up a QR code, a little how-to video, so I don't have to do it again. Boom, delegate out. How do you turn the hot tub on? Nobody has a hot tub here in Florida. So again, same thing, like shoot a little QR code video, delegate, go. And those are the things you just start stacking and going to, learn and understand. That gives you the confidence, and you start making better decisions as you go on to that next deal, and so on and so forth.
So something I want to dive into as well is when you look at acquiring properties, right? I know you probably review hundreds of properties on a monthly basis. I know our tech reviews hundreds of thousands of properties on a monthly basis as well. Like, walk us through how you narrow it down as to where you spend your time, and ultimately what you look for in a property, assuming you have a limited amount of capital to go deploy, right? Versus you can buy everything that seems okay. But if you have limited resources and you're looking at how do I go find the best properties, what we have, what do you go do?
Yeah. So top of funnel is you need to start, with your where. So it's like, okay, what cities, what areas, obviously you got to start with regulation in this asset class. But then once you've narrowed that down, it's like, okay, where does it have a chance to be profitable and hit a yield that we're acceptable taking? Then from there, you're going to figure out what's the optimal type of product, both from a physical exterior, both from a geographical. Is it the north side of town, the east side, south side? Is there a bedroom configuration that has an inefficiency, going small, going large, whatever that might be? So once I kind of have that ideal product mix based on the data, then we're going to understand, okay, what amenities, are necessary to win. And what you kind of want to do is your reverse engineering is you're going to go look at Zillow or the MLS and figure out, like, what can I buy and transform to be as close to this as possible? Now, if you start studying all the top performers, the top 10% for your given buy box, you're like, cool, this is the market. I know the numbers are good. I just need to find that product. It takes roughly at this point about 30 days of studying every listing that hits the market. You start seeing trends and patterns, the same type of homes in the same area. You start looking at price points. That also allows you to find inefficiencies. Who's underpriced that you could take advantage of and jump on. And the more you study and see those listings every day, you kind of gain that little inside edge of knowledge. And so with limited capital, what I look for is strategic advantages. Now, a strategic advantage could be location. It could also be the lot. It could be the physical property. Give you an example, came across a property, had 3 living rooms. In short-term rentals, that's worthless. So one of them is going to get the big sectional. One of them is going to get the pool table and game room. And a big mistake some investors might make is that third one, they put another seating area in there. 2 seating areas isn't going to drive additional revenue. But what is going to do is, and based on how it was set up in the house and deciding which of the 3 to configure, it wasn't like a pass-through or anything. You actually go in and you permit it with a closet, drywall, and electric to make it an additional bedroom. Because, it's a big, 11 by 13 space. So you don't need that third bedroom. So you're looking cool. You're doing value add to the physical real estate, but then you're also increasing your occupancy, which is going to drive more revenue from the rental side. So it's a win-win, both from a pure real estate play that, hey, like we've value added permitted bedrooms to the property overnight. And then also we're driving more, top line revenue, which is going to put more cash in our pocket for that lower basis. Cause I didn't have to buy it at that higher bedroom count. I bought it at the lower one. So those are just little inherent advantages, the size of the yard. Does it have a garage or an office space that I can convert to a movie theater, a gaming area for kids, a bunk room for slides? The more you can stack on top of each other as far as strategic advantages, the more edges you gain, and you're going to continue to be top of market. not only when times are good, but you want to also kind of prepare for a recessionary environment. And if you stay in that top 10% with kind of a moat and strategic advantages, you're still going to get booked during a recessionary period. Affluent people still travel. Maybe the bottom 20% of the population stops traveling. That's going to affect the bottom 20% of listings. And maybe your $700 a night drops to $550, but you know what? You're still getting booked versus being vacant. And that's the risk you run, is you don't have a distinguishable property. You're very middle of the pack and you don't carry any occupancy. But if your ADR is, $700 when times are cooking and you're printing cash, if maybe that drops down to 500, takes a severe hit, you're still making money. But you're able to ride out that recession and ultimately pop out because you had all those strategic advantages. And again, people are going to still book. If we look at upstate New York or the Poconos, which is 2-hour drive from Manhattan, yeah, when times are good, maybe, people in Manhattan fly over to Italy and Portugal and Spain. In a recession, they're like, okay, cool, we're just going to take our family and drive 2 hours over here. That's how you still capture that money and you still ride it out even in a recessionary environment.
Yeah, I think that's a big thing too, is understanding the demographic as to the area that you're in, right? So I think, something you do a great job of is acquiring properties that fit the supply and demand need of that market and also design them. I know you have a big hand in the design and kind of, what goes into properties amenity wise, what goes in there design wise. So on your end, like, how do you understand who the ideal customer is, who's the ideal guest who's staying in a certain area?
Yeah. So a really good way to look at that is when you're studying those top performers, you're going to look at what do they look like. You can also tap into their reviews. Great function on our keyboards, Control F. We can search common keywords: kids, families, bachelorettes, girls, dudes, bachelors, bros, wife, spouse. And you can start looking at how many of those keywords pop up. And so let's just take Scottsdale, for example. If you look at Old Town in downtown itself, you'll see a lot of top performers have women in the photos, like lots of models. There's a lot of products that are pink everywhere. And so it's kind of an indicator just from the visual. And then you start tapping in and you read the reviews and go, oh, this is very bachelorette heavy. But if you go up north, away from downtown, you start seeing families, groups, bros and dudes for the golf getaway. You wouldn't design a pink house or pink amenities and appeal to bachelorettes because it's in the wrong pocket. And so those are like how you're going to figure out what your ideal booking client is. We always say our IBC, based on what are those top performers. You don't have to guess what's going to be appealing in this market. Go look at who's driving the most amount of revenue, and you're going to see what do they visually look like, how are they designed. And then you can start reading their reviews, because that's direct customer feedback. That's telling you exactly who is going to that place and that area. And that's going to give you a really good idea. In addition, if you need a third leg, you can just go look at some of the general tourism numbers provided by the city. You can also understand, like, what are they appealing towards on the website? What kind of photos do they have? And that'll, again, give you a good indication of what that ideal booking client is for that market. That's where you're going to turn around and execute from a design standpoint of how are we going to appeal to these people and maximize all of our potential with this property.
Yeah, speaking of pink houses, Taylor and I actually got one of the first times we hung out. We got to go break in our pink themed Barbie house with, I want to say, 6 guys in our leadership team at the time. It's now grown quite a bit and become much more balanced, a male to female ratio. But at the time, it was actually 6 guys staying there. Our other co-founder, Sabrina, was staying locally at her place because she lives in the area as well. So it was 6 guys who got to break in the Barbie themed house, which was, I believe, featured on HGTV, wasn't it?
Yeah, absolutely. And I love, it's like, oh, which guy's going to take the Moscato room and the Riesling room and the Merlot room? So that all the room names had a little sign. It was named after wine, and nothing like 6 dudes fighting over, oh, I want the Riesling one and I want the Cabernet room. And that was such a great experience. And it's definitely like knowing exactly who you're going to rent to maximize profitability.
Yeah, I mean, that's a huge thing too. So I know there's been actually a shift in the last 6-12 months as to the properties that you're buying and actually how they're being monetized as a percentage of purchase price, right? Help us understand that shift you've made and kind of the impact it's made downstream on both revenue and profitability when looking at how you're choosing to monetize these properties. So Taylor did a great job discussing, how they're going out acquiring properties based on who is actually staying there. I think the amenities flow through really well there as well.
Yeah, you start to learn as maybe you have 3 amenities at this property, And then you start just stacking. So we talked about stacking moats. It's like, okay, let's start stacking amenities. It's like, well, what if we have 4? What if we have 5? What if we have 7? And you almost try to figure out too, like, where does it break? Easy example is like you're running self-storage. You never want to be at 100% occupancy. So you're going to continue to price until it breaks. You want to get whatever, 90, 92%. You need to have something to sell somebody off the corner when they come in, hey, I want to rent a unit. So you want to try to figure out where does it break, from an ROI perspective at some point, like where's our diminishing returns set in? Where can we push market ADRs? And we've just kept learning that we do keep getting a trade as we go. You continue to get differentiated. And when it comes to pricing some of these new units that have come on, especially in the most recent fund, it's kind of like a little bit of price discovery. So when Austin, our head revenue manager, is going in and I have conversations with him because we want to keep that feedback loop of how are things performing? What trends are we noticing to make better acquisition decisions and kind of refine our strategy? So me and him are constantly talking on a feedback loop, and you launch this new property. It's got dozens of, new amenities to it. And he's like, hey, I keep raising the price. And we still keep getting booked. And it's like, I raised it to $1,000 a night. We still got bookings. Then $1,200, we still got bookings. 14, 16, 1,800. Okay. We stopped getting bookings. Okay. Maybe I found the top and it was 1,600 a night. And you just don't know where you can push it. So obviously that's going to eat up more of our out-of-pocket costs. But what you're also seeing is average revenue per property is up over 33% in fund 2 over fund 1. And a lot of that is just, again, you're taking and sucking more out of that individual asset because purchase price is relatively same. It's only up about 3 or 4% from each fund. So it's not like we're buying a 30% more expensive property. Well, then, of course, we would expect the revenue to be up 30% on a proportion basis. You're buying virtually the same, cost property, but you're extracting more out of it. And that, I think, has been a critical component, which naturally, when you extract more revenue in an asset class like this, you have tons of fixed expenses like taxes, insurance, Wi-Fi that aren't going to change. So you're naturally going to have a lower OpEx, which is going to bring more cash flow to the bottom line. Yes, there is variable expenses and you can work on controlling them. But as you grow revenue, you're able to incrementally bring more to the bottom line because you're overcoming all those fixed expenses that whether you generate $1 or $100,000 isn't going to change. Those expenses, that Wi-Fi bill is still going to be there. The taxes, the utilities, shampoo, conditioner, all relatively flat for how much you're going to burn through. Those are the big things that we've kind of learned is we're seeing that trade-off of investing more upfront and pulling in significantly more on the back end. Very
cool. So has anything else changed in terms of, say, furniture you're putting in there, right? In terms of, like what else has changed? Kind of what things are you noticing right now in the space that excite you? What things don't you like? Like kind of what's your forecast and kind of crystal ball for what you think is going to happen in the industry?
Things I've noticed from a operational standpoint, I think that was kind of the first little bit you had was we're actually also investing a little bit more upfront from a maintenance and CapEx. I think what you realize, this is an operations business. This is not a real estate business. It is a operations business that just so happens to have a piece of real estate attached to it. And what you kind of learn is if you don't address issues that are maintenance related up front, they could come back to burn you. And the worst case is, something breaks during a peak season, July 4th booking or something like that. So I think strategically, we've just learned that we should invest in some of those maintenance and CapEx more upfront than rather kind of defer them down the road. And that's allowed operations to be smoother. You're not having to cancel bookings to send a, maintenance tech or a GC in there to fix things. You're not having to address as many issues. It leads to a better guest experience, more revenue and profitability, because again, you're not having to issue refunds, cancel bookings, et cetera. Looking ahead, the high interest rate environment, the shift in maybe people leaving the asset class, I'm kind of excited to see where the dust settles. 2023 was kind of the first getting slapped in the face for a lot of people who, bought a plain 3-2 vinyl siding home, threw it up on Airbnb in 22 or 21 and just printed cash. And all of a sudden they have no differentiating wins, and 2023 hit them in the face. And now 2024, they're seeing the similar results and looking to exit. So there's been a shift in, elite operators rising to the top. So really what I'm excited to see is how does that shuffle end up, ultimately settling? Where do the elite operators hang out, and how much of a divide or gap is there between the middle of the pack? Everybody used to be able to compete and it was very tight on that spread. I'm really curious how far that widens between those who are doing it right and those who are just trying to get by. And the wider that gap is, I think it becomes easier both from what you're offering to guests, the expectations keeps rising. And so the people who have grandma's plaid drapes, in their property, they took their listing photos with their iPhone 8, the non-professionalization, they're just not going to see anything. Whereas the elite operators with great photos, great design, professional, everything are all of a sudden becoming the new standard. So I do think this is a rising tide lifts all boats type of situation. And that's good for everybody, because the more value you can bring, the more everybody can charge. And if they have a great time staying at Sam's place because he has 4 or 5 awesome amenities, great design, and the family has a good time, well, he's probably coming back to the platform to book. And then eventually maybe he winds up at one of my properties. That, I think, is what's really exciting, is to see where that settles and what the new standard and floor becomes, which hopefully it continues to rise, which again will push ADRs up, will push the level of sophistication, and everybody continues to make more money.
Yeah, it's a really good point. Like, I think it's always important to know in business, how does someone get paid? And if you look at a platform host like Airbnb, they make a few points from the host and they make a handful of points from the guests. So they're typically making a percentage of total bookings that go on the platform. So like what Taylor was saying is that if someone stays at your property and has a great experience, they're likely going to say, hey, Airbnb, it's great, I'm going to go book them again. If someone stays at Taylor property and has a horrible experience, they're going to say, you know what? Airbnb sucks. I'm not going to stay there again, whether it's at Taylor's house, my house, someone else's house. So in turn, the platform itself is losing revenue. So if they have a great experience, they're going to go book again, whether it's your house, someone else's house. Either way, the platform gets paid. So if you're a good steward of their brand, I think you're always rewarded handsomely for being quality steward, helping them drive future bookings, and then in turn, likely positioning yourself better in SEO, positioning yourself better in the platform in terms of the representatives. So building that relationship there goes both sides as well.
You absolutely nailed it. If you actually look like really into the weeds of what Airbnb is pushing, but from like a marketing perspective, it's exactly what's going to line their pocketbooks the most. They're pushing new inventory, aka new hosts, and then they're also pushing experienced operators who are continuing to get booked. So to your point, hey, if I can favor these people in SEO because they continue to deliver over and over again, that's in my best interest. Well, if you're an elite operator, that's good for you too. Now, obviously, at the same time, they always want to grow new inventory. Not as great for somebody like us. Hey, you always would prefer less competition. But at the end of the day, if you're continuing to bring on more good opportunities, it just, again, rising tide lifts all boats. And so that's kind of really where the marketing push has been. If you really look at Airbnb as a whole, from a company standpoint, they're just trying to make money. And those are the two ways that they're going to make it, is bringing new inventory online to drive, more opportunities and bookings there, and continue to give favorable opportunities to the people who are actually converting. And so that's a big thing. If you're not converting on your listing, people are clicking on it and then just not actually booking, there's no incentive for the algorithm to push you up to page 1. They're going to shove you down to page 4 or 5, and you're never going to get seen. So that, again, is the huge opportunity that great operators with, again, professional design, elite amenities, great properties that continue to get booked, that's all they want.
Yeah, you nailed it. Before we hop off here, how and why should the listeners reach out to you?
I'm hanging out primarily on Twitter now, formerly Twitter, X, at Mr. Jones STRs. I've started really pushing on LinkedIn as well, so at Taylor Jones. Going to make a push this year here at the end of Q2 to get onto the video side. So some Instagram, TikTok, YouTube. It'll stay the same at Mr. Jones STRs. If you ever want to learn, send me a DM. Calendly's in the bio as well. Feel free to book a call. Happy to talk about your individual short-term rental journey. Is there anything you can get help with, resources? Again, I'm a big believer in the rising tide lifts all boats. I've given away our entire tech stack of, hey, here's all the great technology pieces we incorporate in our business, and feel free to utilize it. And some people are like, man, you're crazy for just giving it away for free. And I'm like, hey, I want everybody to be a good operator, because again, if Sam's a great operator, then it's going to come back to me. And if Sam can charge more, I can charge more. And so everybody using the best tools, the best technology, the best opportunities, we're all going to be able to continue to grow and push. So yeah, feel free to reach out on any of the platforms, and, happy to, provide as much value as I can, within the given, time and space and everything.
Cool. Taylor, thanks for coming on.
Enjoyed it, Sam. Thanks for having me.
Thank you for tuning into the Fully Funded Show hosted by Sam Silverman. If you are enjoying the content, let's take your journey further in the Fully Funded Mastermind. The Fully Funded Mastermind offers more than just insights. It's a mastermind community designed to solve the real challenge of raising capital. By joining, you gain direct access to strategies, coaching, and a network dedicated to turning your financial goals into achievements. Don't let capital raising be a barrier to your success. Visit fullyfunded.capital to explore how our mastermind community can pave your way to financial growth.
Thanks for tuning in to the Fully Funded Show. If you enjoyed today's insights, hit follow, share with your investing pals, and drop us a review. Connect with us on social media for bonus content. Your success is our mission. Keep those funds flowing. See you next time.